Welcome to Wall Street. Billions of dollars move through it every day. Companies come here for money. Investors come here looking for returns. Banks arrange enormous deals. And markets constantly decide what things are worth. But here's the part most people misunderstand. Wall Street isn't just a place. It's a system. And once you understand how that system works, the stock market starts to make a lot more sense. So let's start at the beginning. Where does the money come from? Imagine you build a company. Your business is growing. You need a new factory. You need more employees. Maybe you want to expand across the country. But there's a problem. Growth costs money. You could borrow from a bank, or you could raise money from investors. And this is where financial markets become incredibly important. A company can sell ownership in itself. Those pieces of ownership are called shares. Imagine your company is worth $1 billion. You decide to sell 10% of it. Investors could provide $100 million in exchange for that ownership. Now the company has new capital, and investors own part of the business. This is one of Wall Street's most important functions. Connecting capital with opportunity. People and institutions have money to invest. Businesses need money to grow. Financial markets help connect the two. But there's an important distinction here. The first time a company sells securities to investors is called the primary market. That's where new capital can be raised. But what happens afterward? That's where the secondary market comes in. Imagine you bought shares of a company. A month later, you want to sell them. You're not normally selling them back to the company. You're selling them to another investor. That's the secondary market. And this is where most everyday stock trading happens. This distinction explains something surprisingly important. When you buy a stock from another investor, your money usually isn't going directly to the company. You're buying an existing share. The company already issued it. You're simply changing who owns it. So what actually determines the price? Price discovery. Suppose a stock is trading at $100. One investor thinks it's worth much more. They want to buy. Another investor thinks it's overpriced. They want to sell. Their disagreement creates a market. Buyers compete with sellers, and their orders help determine the price. This process is called price discovery. The market is constantly asking, what are investors willing to pay right now? And that answer can change very quickly. New earnings report, the price can move. Interest rates change, the price can move. A major product succeeds, the price can move. Investors suddenly become nervous, the price can fall. But there's a problem. You can't have a functioning market if buyers and sellers can never find each other. So who helps make trading possible? Enter the market makers. A market maker is a financial firm prepared to buy or sell a security at quoted prices. Think of them as part of the market's plumbing. They help provide liquidity. Liquidity simply means you can buy or sell something without having to wait forever for a willing counterparty. Imagine you own a stock. You want to sell it. If nobody wants to buy it, that's a problem. But if market participants are continuously willing to transact, trading becomes much easier. Market makers help facilitate that process. They can earn revenue from the difference between buying and selling prices, known as the bid-ask spread. But they're also taking risks. Prices can move against them. So market making isn't simply free money. It's a business built around managing enormous amounts of trading activity and risk. Now there's another major player we need to understand. Investment banks. The name can be confusing. Investment banks aren't simply giant versions of your neighborhood bank. One of their major functions is helping organizations raise capital. Imagine a company wants to issue $5 billion in bonds. The company needs investors, but finding those investors isn't as simple as posting an advertisement online. The deal has to be structured. The securities have to be marketed. Investors need information, and the transaction has to be organized. Investment banks can help with that process. They can also help companies issue shares. This is one reason investment banking sits so close to the center of Wall Street. But Wall Street isn't made up only of banks. Some of the biggest participants are institutions managing other people's money. Think about pension funds, mutual funds, insurance companies, university endowments, sovereign wealth funds, and asset management firms. These institutions can control enormous pools of capital, and they have very different goals. A pension fund might be investing for decades. An insurance company needs assets that can help cover future claims. A hedge fund might pursue specific strategies. A retirement investor may simply want long-term growth. They're all participating in the same markets, but they're playing very different roles. And that creates something fascinating. Markets don't require agreement. They require disagreement. One investor thinks a stock is cheap, another thinks it's expensive, one wants to buy, the other wants to sell. That disagreement creates a transaction, and millions of transactions help establish market prices. But there's an even bigger force influencing those prices: interest rates. Imagine you're deciding whether to invest in a risky company. You could potentially earn a high return, but now imagine safer investments are offering significantly higher yields. Suddenly, your decision changes. This is one reason interest rates matter matter so much. They influence the cost of borrowing. They influence investment decisions, and they can change how investors value financial assets. This brings us to one of the most important institutions in the entire system, the Federal Reserve. The Fed is not Wall Street. It doesn't simply control the stock market. Its responsibilities are much broader, but its monetary policy can have enormous effects on financial conditions. When interest rates change, markets pay attention, businesses pay attention, banks pay attention, investors pay attention, consumers pay attention. Why? Because the cost of money has changed, and that can ripple through the entire economy. But don't confuse the Federal Reserve with the U.S. Treasury. They're different. The Treasury is part of the federal government. Among its many responsibilities, it manages the government's finances and issues Treasury securities. Those securities are bought and sold around the world, and they play a huge role in global financial markets. Now let's zoom out, because we've been looking at individual pieces, but Wall Street only makes sense when you see how those pieces connect. A company needs capital. Investors have capital. Investment banks can help arrange financing. Markets allow securities to be traded. Market makers help provide liquidity. Asset managers allocate money. Banks provide financing and financial services. The Treasury issues government debt. The Federal Reserve influences monetary conditions. Regulators establish rules. And clearing and settlement systems help complete transactions after trades are agreed upon. All of these pieces interact constantly, every trading day. But here's where things get really interesting. Wall Street isn't only about stocks. There are bonds, currencies, commodities, derivatives, mortgages, loans, and many other financial instruments. A company might raise money by selling stock, or it might borrow by issuing bonds. A government can borrow through Treasury securities. An investor can use derivatives to manage or take on specific risks. So when people say Wall Street, they're often talking about an enormous collection of markets. Not one market, not one building, and definitely not one group of people. That matters because different participants can have completely different incentives. A long-term investor may want stability. A trader may care about short-term price movements. A company wants affordable financing. A market maker wants to manage trading risk. A regulator wants markets to operate fairly and remain resilient. Their goals don't always line up, and sometimes that creates serious problems. The danger of interconnected finance. Financial institutions are connected through lending, trading, funding, and other relationships. That connection makes the system powerful, but it can also make the system fragile. Imagine one institution suffers a huge loss. That institution may owe money to another institution. The second institution may depend on a third. Suddenly, a problem that started in one place can spread. This is one reason financial crises can become much larger than the original mistake. And it's why regulators care about things like capital, liquidity, risk management, and financial stability. The goal isn't to eliminate every loss. That's impossible. Investing involves risk. The goal is to prevent individual failures from automatically becoming system-wide disasters. And this brings us to one of the biggest misconceptions about Wall Street. Wall Street isn't simply a casino. Yes, people speculate. Yes, traders take risks. Yes, some financial products are extremely complicated. But the basic economic function is much broader. Wall Street helps allocate capital. Think about what that means. A business wants to build something. Investors have savings. Financial markets help determine whether money flows towards that business. The same process happens across thousands of companies and institutions. Money is constantly being redirected from one opportunity to another, from one risk to another, from one investment to another. That's capital allocation, and it affects the real economy because companies use capital to hire workers, build factories, develop products, purchase equipment, expand operations, and invest in research. So financial markets aren't completely separate from everyday life. They're connected to it, and you are probably part of the system. Maybe you have a retirement account. Maybe you own mutual funds or exchange-traded funds. Maybe you're saving for a house. Maybe you work for a publicly traded company. Maybe you simply use products made by companies that depend on financing. You don't need to work in Manhattan to be connected to Wall Street. You can be thousands of miles away. You can be an ordinary worker, a student, a small business owner, or a retiree. The financial system can still affect you because changes in markets can influence borrowing costs, investment returns, business decisions, and economic activity. That's the real story of Wall Street. It's It's not just traders shouting across a room. That image belongs to another era. Modern Wall Street is mostly electronic. It's data centers, algorithms, banks, exchanges, investment firms, institutional investors, regulators, and enormous financial networks moving information and capital at incredible speed. But underneath all that technology, the basic question hasn't changed. Where should money go? Should it finance a company, a government, a new technology, a factory, a home, or a completely different opportunity? Millions of investors answer that question every day. Sometimes they get it right. Sometimes they get it spectacularly wrong. And that's what makes Wall Street so powerful. It can help turn savings into investment. It can help companies grow. It can help governments finance their operations. It can provide markets where risk can be transferred and assets can be traded. But because the system is so interconnected, mistakes can travel just as quickly as money. So the next time you hear Wall Street is up or Wall Street crashed, remember what those words really mean. They're shorthand for a gigantic network of people, institutions, markets, technology, and rules. A system that helps determine where capital flows. A system that influences businesses. A system that affects investors. And ultimately, a system that reaches far beyond Wall Street itself. Because Wall Street isn't really about one street. It's about the movement of money. And understanding that movement means understanding a little more about how the modern economy actually works. Thank you for watching. Hope you enjoyed. See you soon.